You know, if you've ever researched a stock, you've almost certainly seen that little number called beta. It's supposed to be this simple, clean measure of risk. But what if the number you're seeing everywhere is actually misleading you? Today, we're going to break down what beta is, why the standard version has some serious flaws, and how a much smarter approach can give you a truer picture of a company's risk. I mean, the idea is so appealing, right? One single number to tell you everything you need to know about risk. But the real story is just not that simple. What if that number is actually making truly risky stocks look safe and making some safe stocks look risky? We're going to dig into exactly how that happens.
So, what is beta, really? At its core, it's all about sensitivity. It just answers one simple question. When the overall market zigs or zags, how much does this one stock tend to move along with it? Does it amplify that move or does it dampen it?
Let's make that real. A beta of 1 basically means a stock moves in lockstep with the market. Now, a beta of 1.5, you might see this in a tech stock, means it moves 50% more than the market in both directions. And a beta of 0.5, maybe for utility company, means it moves about half as much. Simple enough, right? Well, this is where things get tricky. Okay, so that standard market beta you see on all the finance websites, it turns out it has 4 major blind spots that can seriously throw you off. Let's walk through them. So, problem number 1, it's all about looking in the rearview mirror. It's calculated using nothing but past price movements. Think about it. If a company suddenly takes on a mountain of debt, that risk isn't going to show up in its beta, not until the stock has already tanked. And by then, well, it's way too late. And this leads to a really weird counterintuitive problem. Market beta can actually reward stocks that have already imploded. After a stock just nosedives, say 70%, its beta often actually goes down. Why? Because all that crazy volatility is now in the past. So suddenly, a company that's in deep trouble can look bizarrely safe. Flaw number 3 is a big one. It treats all volatility as equal. So a stock that's rocketing up on amazing news gets treated the same as a stock that's collapsing on terrible news. But come on, as investors, we feel those two things very, very differently, don't we? And last but not least, it's totally arbitrary. I mean, if you change the time frame you're looking at from 1 year to 5 years, you can get a completely different beta for the exact same stock. There's no single correct time window, which kind of makes you wonder how reliable that number really is. So with all these problems, what's the solution? Well, this is exactly why fffinstill created an alternative. It's called fundamental beta. And the whole idea is to stop looking at those squiggly price lines from the past and instead measure the risk that's baked right into the company's actual business. And this really gets to the heart of the difference. You've got market beta, which is all about past price moves and, market moods. Then you have fundamental beta, which is all about the real underlying business risk pulled straight from the company's financial statements. It's the difference between what a stock has been doing and what the business is. So how does this actually work? Well, ffistill's model digs into 8 key parts of a business. We're talking about things like how steady its earnings are, how much debt it's carrying, its size, that kind of stuff. And the 2 biggest factors, the real heavy hitters, earnings variability and financial leverage. Because let's face it, shaky earnings and a pile of debt, that's where the real risk lives. Okay, let's put this into action and see what happens with some famous stocks. Because when you use fundamental beta, you start to see some really surprising things. Truths that the old market beta just completely misses. All right, check this out. You've got Microsoft's super stable business has a very low fundamental beta. That makes sense. But look at the others. This is where it gets interesting. Tesla, Johnson & Johnson, and Nvidia, they're about to flip what you'd expect. So here's the big question. How on earth can Tesla, the poster child for a volatile stock, have a lower fundamental risk than good old safe Johnson & Johnson? It's because fundamental beta is designed to look right past the daily headlines and stock bounces. It sees that Tesla actually has low debt, while J&J's earnings have gotten a bit more wobbly lately. See, it's measuring the business, not the buzz. And it's the exact same idea with Nvidia. We all know the stock price is a total roller coaster, but its fundamental beta, a surprisingly moderate 0.85. And the reason is, the actual business has low leverage and pretty stable earnings. All that crazy volatility you see in the stock, that's coming from market sentiment, from people arguing about valuation. It's not coming from a shaky business. And you can zoom out and see this same pattern across entire sectors. Some industries are just fundamentally riskier than others, just based on how they operate.
Take energy companies, for instance. Their fate is tied to the crazy swings of commodity prices.
Yeah, and this chart makes it super clear. You've got the energy sector way up there with the most fundamental risk, and way down at the other end, you have utilities. Which makes sense, right? They have regulated, predictable income. What's really interesting is that tech actually lands right around the market average. Why? Because the absolute giants, like Apple and Microsoft, balance out all the riskier, smaller players. Okay, so this is all really cool, but what does it actually mean for you? How can you actually use this information as an investor? Well, here are three pretty straightforward ways. First, you can use it as a kind of temperature check on your whole portfolio to see how much risk you're really taking on. Second, you can use it as a filter to screen for companies that actually fit your own comfort level with risk. And third, it's great for comparing two similar companies. A lot of the time, the one with the lower fundamental beta is probably the smarter bet, risk-wise. So at the end of the day, it really boils down to this one question. When you look at a stock's beta, are you just looking at its past behavior, all that market noise? Or are you looking for something deeper, for the true fundamental risk that's actually built into the business itself? And honestly, understanding that difference can be a total game changer for making smarter investment decisions. If you want to dive in and explore the fundamental beta for thousands of different stocks, you should definitely follow fffinstill. And hey, while you're at it, check out the more than 300 free learning concepts over at fffinstill.com. Thanks so much for tuning in.